Hey guys, welcome back to the TFSA challenge. And this is week 7 of the challenge where I'm taking a $2,000 portfolio all the way to $50,000 hopefully by the end of 3 years. I'll be depositing $200 every single week to show you guys how dollar cost averaging can be powerful over time. In this week's episode, I'm going to be going over a recent article that's talking about Warren Buffett and how he warns investors not to gamble on stocks. After that, I'll dive into my portfolio, go over what stocks I bought this week, as well as talk about what stocks I'm looking to buy next week and the reason for that. And finally, we'll be ending this episode off with some questions from you guys from last week. And remember, if you have questions, leave them down below in the comment section, and if it's interesting enough, then I will pick it and answer it live on one of these episodes. So let's first start off with this article of Warren Buffett warning investors not to gamble on stocks. So right here in the beginning, billionaire Warren Buffett warned people not to think investing is an easy way to make a fortune, as he answered a variety of questions at Berkshire Hathaway's annual shareholder meeting on Saturday. He states, "There's a lot more to picking stocks than figuring out what will be an incredible industry in the future. I just want to tell you that it's not as easy as it sounds." And I think that there is some nugget of truth in this. So over the past year, we've seen that a lot of people have been going into these penny stocks, where there's a lot of hope, but there's also a lot of mystery behind these companies. So you see these meteoric rises in prices where a 5-cent stock can go all the way to $1. And you're probably sitting there when you view these stocks, you're like, man, why didn't I get in at 5 cents? Because I could have 20x my money or 18x my money. As soon as you buy in at 90 cents or $1, you realize the stock starts to take a tumble. And this is really ultimately what Warren Buffett is warning against, where people are looking at stock prices, seeing how much they've risen in the past, and buying into them, hoping that they'll do the same thing going forwards. And on this channel, I always talk about having a thesis behind each position and knowing why you're buying the business. So when you're buying a business, you should always be able to understand how they actually make money in the first place. And if they're not profitable, you should also understand how they're going to get to profitability. And lastly, you should look at things like management team, past track records from them to see if there's a good chance that they're also going to be able to replicate or make this business successful. Ultimately, no one actually knows what's going to happen in the stock market in the near future, but if you buy in, if the fundamentals are strong behind a business and you have a thesis, then I think that's a smart way to invest versus just looking at stock price and hoping that it's going to do the exact same thing that it did in the past year. Moving on, Buffett has said that most people will fare better by owning an S&P 500 index fund instead of betting on individual stocks. He said many of the novice investors who jumped into the market recently and drove up the value of video game retailer Gamestop are essentially gambling. So honestly, I'd love to hear your comments in the comment section down below. What do you guys think of this comment? Were you guys gambling when you bought into GameStop? Or did you think that those people who bought into GameStop were gambling? Because ultimately, I think there's kind of two views out there. Some people actually did the due diligence and truly believe that the stock was undervalued. Some people traded based on the short-term fundamentals or really just short-term statistics like the short interest, hoping that there would be a short squeeze. And other people just traded because their friends said so. Buffett also talks about stock trading platforms that allow people to buy and sell stocks for free, such as Robinhood, are only encouraging that gambling. You know, we're here in Canada right now and we don't have Robinhood. However, we do have Wealthsimple, which is essentially a similar platform. Although I think Wealthsimple did, their sort of part in all this gambling aspect to warn investors against these highly volatile stocks. So I noticed when I clicked on certain stocks that were maybe like penny stocks or things related to Bitcoin and stuff, there was always a warning above the chart saying that this stock is very volatile, it's very risky if you decide to buy into it. But ultimately, who's going to really heed that warning if they've already clicked on that stock and are looking at it? When people click onto a stock, they already have the intention to buy for the most part. Looking at the charts on Wealthsimple are not going to change their mind. Really, the only way that's going to change their mind is if they watch a video or if they do their own due diligence and realize the company is actually not a good company at all. So in a way, I think Wealthsimple, there is that same problem there. Perhaps there needs to be further education on why these stocks are not a good choice for investments, especially for beginner people. Maybe they have to do their own sort of due diligence and present it to that investor what the risks are, possibly showing like you've got a 90% chance that the stock is going to fall and a 10% chance that it could go to the moon. I don't exactly know how they would do that, but I think if they were to educate investors on the risk a bit more, then that would really benefit the entire investing community and not have retail investors screwed by these stocks that are pumped up. Further down in the article, Buffett said that he doesn't regret selling off Berkshire's $6 billion stake in all the major airlines last year, even though those stocks have grown significantly since he sold them last spring. Buffett also says he thinks the airlines might not have been able to secure as much government aid as they have during the pandemic if they still had a very rich major shareholder like us. So I remember back in March, April, May time when there was all the news about Warren Buffett and Berkshire Hathaway selling off the airline stocks. And when you look back 2020 at the price chart, you would probably think Warren Buffett, that guy was kind of dumb for selling it off because look at the price of the airline stocks. He believes that the outcome for these stocks would not have been the same if he was still a shareholder. So in a way, he saw the situation when he looked back. If he was still a major shareholder, there may still have been more decline, as those airlines may not have had actually access to government capital because they had a very rich shareholder. And that would have ultimately caused these airlines, possibly some of them, to actually shut down. So when we look back and how Warren Buffett reflects on his decision to sell the airlines, he still has no regret about his choice, even though it costed him billions of dollars. And I think that's what we have to do as investors. When we buy stocks, we have to realize why we're buying them. And when we choose to exit stocks, we have to understand also the reason for exiting them. They're not obviously going to be the same as Warren Buffett's because we're not a rich investor that can move a company. But I think that when we're selling out of stocks, we should understand why we're doing it. And we shouldn't just be doing it because the price went up by 2x or 3x. Maybe a good reason for actually selling a stock after a huge run up in the stock is saying that, hey, now there's a lot more risk on this stock because the prices ran up a lot higher. And originally what I paid for it, I felt like its fair value wasn't as high as it is right now. So I think we as investors should learn and strive to be like Warren Buffett and have the whys when we're choosing to sell a stock as well as buy our stocks. Now in the shareholder meeting, there are some questions about Bitcoin and cryptocurrencies because right now they're hot, and Charlie Munger had a piece to say about that. He says, "I don't welcome a currency that is so useful to kidnappers and extortionists and so forth," Munger said. "Nor do I like shoveling out a few extra billions and billions and billions of dollars to someone who just invented a new financial product out of thin air. I think I should say modestly that I think the whole damn development is disgusting and contrary to the interests of civilization." So I don't exactly agree with Charlie Munger on this comment. I don't think that these cryptocurrencies were created out of thin air. Well, at least Bitcoin wasn't. I guess I can agree with him on some certain cryptocurrencies out there that were created out of thin air by a centralized organization. But for Bitcoin specifically, I don't believe that Bitcoin is created out of thin air. And I don't think it's actually an abomination to society. In fact, I think it's fairly equivalent to gold. If we look at the history of gold, gold started out, when there's a huge gold rush, people just went out to the rivers and were able to find gold by sifting through it. And the reason why gold ultimately had its value is the amount of work it actually took to create that gold itself. Like things like you got mining costs, you've got refinement costs, as well as transportation. And ultimately that's what the price of gold right now is backed by. Likewise, Bitcoin is also backed by the price of electricity, albeit Bitcoin's a lot more volatile. Certain times, Bitcoin's price actually has a huge gap between its production costs. In other times during the bear markets, the costs are pretty much 1-to-1. I think that right now, when Bitcoin is running up like crazy, it's fair that these billionaires are very worried about Bitcoin and its collapse. However, I think that when Bitcoin does collapse, it always comes back down to the amount of electricity that it costs to make that coin, and that's usually where Bitcoin actually finds its value. So these are the few points that I wanted to go over in this article. Now let's jump over to my portfolio and see what happened this past week and what I'll be doing in this coming week. So starting off with the total portfolio metrics. My total value is around $3,229.61. The total book value is just a little bit higher than my current market value, meaning my portfolio is down roughly around 0.5%. If we compare that to the TSX since I started this portfolio, it's up by 0.71%. But remember, March 16th was only about a month and a half ago. So I'm not too worried that my portfolio is down compared to the TSX. Obviously, it kind of sucks just seeing that. But at the same time, I'm investing for 3 years out from now, not 2 months out from now. And no one, well, I personally don't believe that anyone can really predict what's going to happen in the next 2 months. Some technical analysis can be done here and there. However, that's not exactly what I'm shooting for in this portfolio. So far to date, I've collected $7.05 in dividends, and we'll see later on in the transactions tab that I actually did collect a couple dividends this week. I've highlighted this week's purchases as well as deposits. So you can see that on the 27th, I deposited $200 of cash. And then on the same day, on the 27th, I bought some shares of Dollarama. So I bought 2 shares at $57.20. I bought Well Health the next day on the 28th, 3 shares for $7.59. Then I bought a new stock here. This is actually the Purpose Bitcoin ETF, the non-currency hedge fund. I bought BTCC.B, 5 shares for $10.07. Then I bought, with the last remaining $20 in the account, some Algonquin Power Corps, 1 share for $20.03. And then you can see down here I received 2 dividends, one from Power Corporation of Canada and the other one from TD Bank. So last week, I wasn't exactly planning on buying the Bitcoin ETF. However, with the whole drop in cryptocurrencies, I looked at it and I think this is actually a good short-term swing trade for this portfolio. But I do believe that I'm managing my risk by only putting about $50 into it so far. I'll probably build it up to maybe $200. And when we're looking at the total value of this portfolio, it's $3,229. So that would be less than 10% of this portfolio if I brought that position up to $200. Now, dissecting my portfolio a bit more, I've actually sorted it based on profit and loss of my positions here on the percentage return. So you can see the stocks that are down the most, again, are a high risk stock like Well Health, medium risk like Air Canada, and high risk like GDMP. So I personally, again, I'm investing for 3 years out, and I'm not too worried about seeing a 10% decline. I think that these are short-term moves, and I believe these companies will be more valuable 3 years down the road, based on the research that I've done in them. They're continuing to create shareholder value as well as value for the customers, and ultimately I believe that their businesses will succeed. But them being high risk as well as small market cap stocks, that means there's going to be a lot more volatility in the stock. So it's very difficult to predict the price in the next couple of months. But I do believe 2-3 years out from now, they should be better off unless there's some huge event that happens with these companies. Another interesting stock that I noticed here that was down quite a bit is Enghouse. And that's actually a position that I do truly plan to add this week. And I recently looked at Enghouse and just some of the reports out there. If I just pull up this tab here on Enghouse from Finbox, they do multiple different valuations. They have 15 models, discount cash flows, 5-year and 10 years. They have dividend stable growth models, PE multiples, EBITDA multiples. And currently Finbox believes Enghouse should be more valued around $67.12. If we look at the stock chart for Enghouse, right now you can see that Enghouse did have their fall in 2020 last year, but also had a meteoric rise. If we look at their financials, we can actually get an idea of how they've been growing as a company. So this is the quarterly view, and Enghouse has grown 58% at the beginning of the pandemic. And then they grew 29%, 10%, and 7%. So the growth is slowing down a little bit. And that's probably why the stock actually sold off. If we look at Enghouse stock here on April 30th, you can see it was trading around $51 per share. And when the earnings came out, there was a huge rise in the stock and it continued to go up and up. I think this is sort of fueled by investors seeing that 58 or 59% growth and they're buying into the stock. However, the growth story started to slow down as we saw over here, where it dropped to 29, 10, and 7. And that's probably why the stock continued to sell off. But I do believe that Enghouse is a solid dividend-paying stock, and right now it's relatively fairly valued or even undervalued according to these models that Finbox puts out. The company continues to raise their dividend as well as they issued a special dividend in last December. So the dividend increased by 18% year over year, and that was in the latest earnings on March 11th. So as a shareholder of Enghouse, holding this for 3 years, I have no problem in holding this company and believe that it will do well in the long term. So for this week, my plan is to concentrate my capital into Enghouse to build up this position a little bit more as it's down about 5%. As well as I'll concentrate the remaining half of it on this Bitcoin ETF because it's still a very small position in this portfolio. And I do believe the fair value of Bitcoin, or what it will reach at the end of this rise, is going to be a lot higher than what it is today. It's probably going to reach 80K, if not 100K according to the stock to flow model. So therefore, I believe that there's at least a 60% upside to this position. So the first question that we have today comes from Shabana Beg. And the question reads, how are you able to do dollar cost averaging on the Wealthsimple platform? So dollar cost averaging is essentially just putting in a set amount of money, at least in my case, every single week and buying into a select portfolio of stocks. So I'm able to dollar cost average in Wealthsimple Trade a lot more easier because there are no transaction fees. If I were doing this on Questrade or TD, I would be paying $5 to $10 every single transaction. And if I'm buying 1 or 2 shares here and there with an average total cost of $50 to $100, then I'm paying anywhere from 10 to 20% in commission fees every time I buy. But Wealthsimple Trade, the fact that I don't pay commission fees at all, allows me to dollar cost average in very efficiently. Albeit I'm probably not getting the best price for the shares at that exact moment. There's probably a gap of anywhere from 3 to 4 cents on a share that's worth, let's say, $50. But then again, if I'm only buying one share, then I'm paying that 4 or 8 cent difference to be able to buy those shares for free instead of paying $10 flat every single trade. If I was buying like $8,000 worth of shares, then in that case, I may be more particular on my brokerage in understanding how the fees actually work. And in terms of the bid-ask spread, what is the company actually charging me? The next question comes from Zmaster21. And his question reads, what's your recommendation for a 20-year-old investor? What kind of risk should they aim for? So personally, I think that everyone's situation is a little bit different. If you have a steady income, very little debt, and don't need the money in the short term, then I would tend to lean more towards a higher risk portfolio. Maybe risk levels of 50-50 or even 80-20, 80 being high risk and 20 being more safer stocks. That being said, every person's situation is very different, and if you can't stomach the losses, then maybe you want to flip around and do 20% high risk and 80% low risk. At the end of the day, you need to be able to map out your plan for what you're using this investment money for. If it's for retirement and you really can't spare to lose any sort of money in there, and you need to always earn 7%, then perhaps investing in an ETF is what you want to do. But if you're putting your money into your RSP and you know that by the end of your career, you're still going to have a fairly good salary and being able to save up more on the side in a TFSA or a personal account, and you just want to have some play money in your RSP, maybe you even go with an 80% risk, high risk, and 20% low risk. For me personally, I've kind of taken the approach of going more high risk stocks, however, diversifying over a lot of high risk companies. And the reason why I'm doing this is because I do truly believe that technology stocks that are, currently in their growth phase, some of these might end up becoming dud, but some of them also could become a 10 bagger or even have a 100x on my initial investment because I got in early. And I'm always looking for new and innovative technologies that I do believe will have a huge impact on our future. You could say my approach is a little bit like venture capitalists, where I spread out my money amongst multiple different companies, not really knowing which one will actually be the winner because no one will know, but I'm spreading out my risk and anticipating that maybe 1 or 2 of them will be a huge winner, and maybe 3 or 4 of them could end up going to zero. However, at the end of the day, I do believe that diversifying in these high-risk investments, but if you're pretty ballsy and you think that you can pick the next Tesla out there, then that's ultimately a personal decision for you to make. So I don't have a hard and fast answer for you, but I think you really have to consider your own personal situation and how much risk that you can afford. And really just do the back calculation for what you're using this money for. If it's for retirement, if it's for buying a boat, for buying a house, then figure out how you're going to get there and the right strategy or investing strategy that suits your need. But one thing that I would really highly recommend is paying off any high interest debt. So personally, I think high interest right now is probably like 5% and above. And the reason why is that if you're able to make 7% on average in the stock market, you're going to be taxed on that as well. So let's say you end up making like actually 5% after taxes. You're better off to actually go pay off your 5% plus interest debt rather than investing in the stock market right now. So that concludes it for this week's episode. Be sure to leave a question down below to have a chance of it being answered in next week's episode. If you guys want to check out my previous TFSA videos, they're up on the screen right here. If you're there, I'll see you there. If not, keep up the grind and have a great day.